Hello and welcome to the download. I'm your host, Dave Richardson, and we've been away for a bit. So I thought it was a great time to bring back our old favorite, Stu Kedwell, the co-head of global equity with RBC Global Asset Management, for what we fondly call Tuesdays, because Tuesdays was there felt like there was something missing before we started doing this podcast with you, Stu. And now it's become Tuesdays. It's taking off everywhere. It's like when my mother created Thanksgiving after I was born.
Yeah. Well, that's very kind. It's like this is the eve of Hump Day, right? Because Wednesday is
The
the middle of the week, so this is kind of the pregame to the middle of the week.
Pre-game to the middle of the week, and maybe I don't know if we've got anybody in our business whose last name is Hump or rhymes with Hump. So we'll figure that out and get them on the podcast. But this is I mean, you're smiling, but this is it a sad day? Because I know someone you think quite highly of announced their retirement at age 95, I will say, like, or 94. I'm not exactly sure. It's 94 or 95, and that'd be Warren Buffett. And I think we can all learn. And for those people who listen to the podcast on a regular basis, know you've come back and quoted Warren Buffett and used some examples of things that he does as an investment manager that have inspired or influenced many professional investment managers. But just getting your thoughts. I know you've got, based on what I know, that gives you 50 years left in your investment management career.
Yeah.
But what are your thoughts on Mr. Buffett and his retirement?
Well, I'm sitting here and propping up my phone as Snowball and Poor Charlie's Almanac. So yeah, definitely a fan. Who's not? So much has been said. I think when I meet a younger person who wants to enter the business, the two things I suggest are reading every one of his annual letters. They are, pure gold,
Yes.
as to quote Jerry Seinfeld, pure gold. And then, the second is learning to read the Wall Street Journal and the Financial Times. But if you had to pick one, you would just pick, all the Warren Buffett letters. And whether or not it's behavior, whether or not it's how share exchange works, how all sorts of from complicated financial elements to, as I say, to pure kind of behavioral psychology. He is the master. So I would tip my hat like everyone else. And a lot has been said, a lot will be said, but just a wonderful investor and educator for the masses, myself included.
Yeah, and I mean those are great points about the investor letter is something that I think almost anyone could read, and get quite a bit out of it every year. Again, just if you're not into the technical elements of investing, just again the wisdom, the patience, which is some of the things that we talk about on this podcast all the time. Taking emotion out of it, not following the herd, all of those things, which come out in all of his writings and sayings are things that I know have helped me as an investor personally and professionally, and I know are an influence for people who actually do it day to day like you.
Yeah, no, it's bang on. Like, everyone has their favorite. My story. Mine is, during long-term capital management, because we were talking about the bond market a couple of weeks ago, and some of the dislocation in the long-term capital management was right when I started in the business, 1998, and there were some large hedge funds, long-term capital management, that was very levered, buying off-the-run treasury bonds and financing them with on-the-run treasury bonds. And that's a little complicated in itself, but it's like trying to pick up the spread between two bonds, and they used a lot of leverage, almost 100 times. Anyways, this portfolio fell into trouble, and they're trying to figure out what to do with it. And Warren said, "I'll take the whole thing, and then you go around the world and tell people it's in safe hands." And of course, if that had taken place, the spread would have immediately collapsed, because the problem wasn't the security of the assets. The problem was the amount of leverage. And as
Leverage.
soon as you knew that there was no point in pushing against that trade anymore, the spreads would, collapse back to their long-term average, and he would have made, a tremendous amount of money if that had taken place. I think that was the kind of the beauty of his teachings was like there was how a business compounds over time, but there was also the intricacies of the market and handicapping odds and all sorts of things. And but having safe hands and it's just a wonderful way to think about investing.
Yeah, and when the and my favorite was when when the tide goes out, you find out who's not wearing a bathing
Yeah,
suit, right?
yeah, that's right.
And at the ocean, that's but yeah, lots of great wisdom and obviously, I did a video yesterday for some advisors, and you just look at the rate of return. CNBC put up the 60-year return was 5.5 million%,
Wow.
which is it falls a little bit short of yours, but
Yeah, that's right.
or no, we actually I know I'm not allowed to say that. That was a joke. That
Yeah.
was but the 5.5 million% over 60 years is again you work it out. I think it works out to a little under 20% compounded annual rate of return. But in stocks, we'd say stocks, and we've talked about that a lot on the podcast. 8 to 9% over the long haul to kind of double that rate of return over 60 years is just phenomenal.
Yeah, something else.
Something else. So we've got that sadness out of the way. Now we'll turn to what we normally do. By the way, Stu has also started recommending the Buffett Investment Letter, Wall Street Journal, Financial Times, and the Download podcast. We'd love you to subscribe. We're on YouTube too. You can click. You can follow us on the YouTube version if you like looking at us. Again, as I always say, more people prefer to just listen to us than look at us. And give us a rating. We'd love to get a review from you. And so we're going to go into a bunch of stuff because we haven't been on for a couple of weeks. But Stu, we're sitting here. If we look at stocks, we had in the U.S. we were down a little bit over 20%. Canada was more like 17. We've seen a pretty significant bounce back from those low levels. Still plenty of volatility. What do you make of what's happening right now? Is this still kind of what you've been saying all along, or are you seeing anything different as you spend the last 2 week tracking markets?
Yeah, so maybe on that front, we'll start off with our economist does a tariff uncertainty chart, and that really kind of peaked right at the or that the high of that uncertainty peaked with the low in the market. So sometimes it's worth kind of going through things and say, well, what can you say for sure or close to for sure? And in this instance, we probably have gone through peak uncertainty over tariffs. The second thing we could say for sure is that sentiment and some of the technical indicators, really stretched in favor for long-term investors at those low prices. So that has somewhat normalized as we've come back up the top. The things that you then get into the list of what do you have trouble saying with as much confidence, and I think there's two aspects that kind of leave stocks a little bit in no man's land for the shorter term investor. The first is earnings estimates. The first quarter's earnings were quite good, but they didn't really reflect any of the change in confidence or the potential for tariffs. And we have seen estimate revision come down. And the second thing is the valuation of the stock market, after the big rebound, is back to a level that it's not expensive, but it's not cheap, right? It's
Yeah.
we're paying a fuller valuation for estimates that we don't have as much confidence in, and normally to kind of get through that, like you want one or the other, right? You either want a ton of confidence in the estimates or you want a lower valuation. And that's why I think in the short term here, it's a little bit more kind of no man landish. I think to the positive, people are maybe hopeful. Certainly still possible, this kind of belief that what's taken place has largely been the result of a certain set of actions by the Trump government, and the administration could undo some of those things. And then, would we go back to, kind of where we were? The only thing that kind of offsets that is that confidence is low on many of the surveys, and the longer it stays low, it starts to affect some behavior. So, those are the types of things that that we're kind of working through. It leaves us at levels on the markets that are you know our dollar cost averaging thing is, that's not changing at all in this environment. But, some of the technical aspects that presented themselves, 6 or 8 weeks ago, which were quite attractive, now we're at a point where, we need to kind of monitor things from here. And, we can look through and we can look for positives, and the positives would be, the financial stocks have
Yeah.
largely been pretty strong.
Right.
And that could be that, yes, there's going to be credit losses, but the yield curve is going to have more positive slope for a while. So even on the other side of credit losses, earnings can be stronger.
Yeah.
Some of the big, what they call hyperscalers, the providers of the big data centers and all that capacity, they've been not bad. But some of the kind of suppliers to the data centers haven't really kind of re-engaged quite the same way, or some of the semiconductors and cyclical oriented businesses haven't been, at this juncture anyways, been willing to kind of look past the valley. So so that's why kind of in this, there's pros and cons.
Yeah. So when you're out talking to companies, what are they how are you seeing them react and respond? I think we did initial a few weeks ago, we did a piece just around the where how a strong management team works
Yeah.
through something like this versus maybe one that's not as experienced, or that ends up not making decisions probably as quickly and as decisively as they should. What are you seeing across the gamut there in terms of what people are what leaders at companies are doing in reaction to this back and forth on tariffs?
Yeah. So like, companies are running a lot of scenarios just like investors do, and the best ones are using the biggest imagination they can. So there's kind of two things that face them. The first is maximizing the assets they have, and that one's a little more straightforward. If one revenue source looks like it's changing, then you alter the path of that revenue to a different source. That one is pretty par for the course. The thing that is paralyzing for almost all management teams is where to put new capital investment, right? So, like, if you were an importer, did you use your line of credit to advance your imports before the tariffs? Probably, right? That's just a good business decision to get that stuff into your warehouses at better pricing than you would pay later on. But in terms of, where am I going to expand my factory, or am I going to expand this or expand that? Those decisions are, still waiting for, certain outcomes. And, that's the thing that really has, kind of ground to a halt. It's one thing, I was having a discussion with one CEO, and he said, well, it's one thing when, the stock market goes, down, 10 or 12% in a few days, and then 2 weeks later is back to where it started. He's like, that just does not align at all with how capital is actually put to work in the real world. So, that's kind of goes back to that confidence component. And the longer the confidence surveys, sit at lower levels, that's where you worry about a bit more of a permanent effect.
Yeah, and we were talking to Eric Lascelles about this on Friday, which was the last posted podcast that we had. And this whole idea, okay, well, so we started in late January with this, and so we go a month of uncertainty, and then it goes to 2 months and 3 months. Now we're at 3.5 months, and still not really sure if we're going to get to an end. Maybe, as you suggest, the peak uncertainty is past, but that doesn't remove that still, if I'm running a business, I really don't know. I might be a touch more confident now than before, but I really don't know exactly how this is going to play out. So to make big decisions is really hard. And so you go from 3 months to 6 months to 9 months, and at some point that filters through the economy and hits earnings, right? And that's kind of the anticipation anyways. But the longer this drags out, the more of a possibility that this leaves a mark, as they say.
Yeah, I think that's true. And then, for Canadian business, like it does look like the government is going to do some proactive things, to kind of stimulate the economy and what have you. So, to the extent that they can get some clarity on a non-trading oriented investment, that would be a positive. Like you can always look through, kind of like, the second derivative. We've talked about that a lot. Like, what, just like the Canadian dollar at its worst was 148, today we're at 137. Like the tariffs are probably not going to be as bad for Canada as the kind of 25% fear.
Yeah.
The government, the election is likely going to be, a positive for the economy at some point. So there are always, positives out there, but I don't think there's like quite the list yet where you're going to get, business ready to significantly invest behind those two things. You still need a bit more clarity.
And then on top of that, and when we talk about valuations, we're often talking about the S&P 500. But if we do come home to Canada, or if you look in Europe or other parts of the world, the valuations aren't as high as certain parts of the U.S. market. And so even there, so we see it on the downside, and maybe this is just maybe not as precise as I'm putting it forward, but S&P 500 is down 21%, TSX is down 17, peak to trough on the
Yep.
pullback on tariffs. So, some of that is a bit of valuation, and then particularly concentration of the valuation of high valuations in a particular part of the US market where you don't have as much of that represented in the Canadian market.
Yeah, 100%. I think at the lows, we ran the valuations of every sector in the TSX, not just the market as a whole. And every sector was below its, kind of 10-year average valuation.
Yeah.
So that's the type of, going back to that, that point about earnings and valuation, like the two-legged stool. Like if every component of valuation is below average, then I'm getting compensated for some type of earnings concern.
Yes.
And so that definitely feels a little bit better. And you can see that around the world, really outside of the S&P. Most of the global markets valuation is not too bad. Um, excuse me. I think I go back to the podcast we did in London, which is right after Liberation
Yeah.
Day, and we talked about some of the currency movement, and that being a bit of a shot across the bow. That has continued. And last week we saw some Asian currencies be quite strong, really out of
Yeah.
nowhere. Um, when you have you own an asset and the currency with which you hold it in is depreciating against yours, it does add to some tension in terms of holding it. And we've seen a lot of capital flow, and we think we're in the early days of that, that kind of movement towards maybe non-US markets.
Yeah, and it's hard. And this is one of the things I was listening to a commentator this morning as I was driving to the office, and for the U.S. And getting the toothpaste back in the tube, uh, y- y- you know, the, about a huge portion of global capital was flowing into the US because of the strength of US markets, strength of the US economy, strength of the US dollar. And now all of a sudden you've unwound some of that. So now I'm less certain of US markets, the US economy, the US dollar. And all of a sudden you see that capital looking for another place to go. And then once that starts and you start, oh, well, wow, there's some great bargains here in Canada, great bargains here in Europe, great bargains here in Asia. It's hard to know, no, come on back. We're still the same old US you thought we were, but you're not. You've cracked that illusion. And that's something that we worried about out loud on the podcast over the last couple of years when the US just kept going up and everything else was
Yep.
going up as well, but just nowhere near as fast. And then at some point, that has to shift because there are opportunities everywhere. And investors, one of the great things about being an investor in 2025 is you can take your money and you can invest anywhere you want. You're not stuck in Canada. You're not stuck in the US. You can go anywhere. You find the best opportunity. And I mean, that's what you do for a living. And that's what every investor can do. And so when you there was going to be something that was going to, tip the scale the other way a little bit. And sure enough, it might have been the tariffs. And now we're seeing all of this unwind. So it's interesting to watch.
Yeah, no question. And there is always a bit of a momentum aspect to these. I was driving my daughter home the other day, and there was a store that never has a line, and all of a sudden had a line all the way down the street. And you just naturally want to pull the car over. You're like, well, something must be going on in there.
Something's going on. Yeah. Yeah.
Why is everyone lined up? And so when we get these kind of momentum moves, we have to really think through the fundamentals that are happening behind them. But sometime, one of the things that we like to say, opinions about prices often matter just as much about the price themselves. And sometimes in a murky environment, new things emerge. And to our discussion here today, like the currency changes have definitely been the bigger story than the equity market or really the bond market for that matter in the last month.
Well, all of this has made us 10% wealthier if we ever go over the border again when we go down there. So,
Yeah.
anyways, let's just shift to one thing that we have seen also weaken through over the last several months, and that's the price of oil.
Yep.
Which is, I think I didn't look at it today, but we're well under $60 a barrel. I think we got down to around 55 overnight on Monday, and that's down from we were in a pretty established range of sort of 70 to $85 a barrel for a while, and certainly been higher coming out of COVID. And this is, I mean, I guess it's kind of a surprise, although it was talked about a lot as one of the things that the administration in the U.S. wanted to do was to tap the price of oil down. Certainly a concern for U.S. producers. We're already seeing that. But what about in Canada? Because we produce a lot of oil here.
Yep.
And it's a big part of our market. What would you say about the difference between a Canadian and U.S. producer?
Yeah. Well, the big difference is when you produce from the oil sands, it's much more like a manufacturing operation than it is a conventional energy operation. So, for sake of financial purposes, you have a unlimited reserve life. So, the price that you're getting for your crude, as long as it covers your cash costs, which it more than does enough, you've got money left over to pay your dividends and all sorts of things. You don't have to worry about taking that cash and reinvesting it because your reserve life is not declining. Versus if you're in the United States and you're drilling a well that might have a 3 or 4 year reserve life, the price that you get for crude during that 4 years is very important because it totally dictates your ability to keep drilling, to do it all again. And so that's a big difference right now, anyways, for Canadian crude producers versus some elsewhere in the world. So, I speaking, and we're not totally at an extreme, but you want to talk about commodities when they're at extremes because the solution to high prices is high prices, and the solution to low prices is low prices. So this began with OPEC being concerned that some producers were maybe putting a little bit more into the supply than they were all supposed to. So there's kind of a disciplining angle to this that started to cause the downward price movement. But when you get downward price movement, a couple of things happen. The first is you will eventually get a supply response once oil goes below 60. You're not really making the marginal cost of a new well. And once you get anywhere kind of 50 and below, you're not really covering the cash costs of some existing wells. So that will lead to a supply response. And then the other thing that happens is when oil goes down, demand goes up a little bit. And that has been a source of concern because the global economy might stall a little bit given everything going on. So if you bring the price of crude down, you'll accelerate that. People will drive more, they'll do more things, that type of thing. So um, some markets, when you get a negative price signal, you want to take that as something to go think about. But when it comes to commodities, negative prices often are the solution in and of themselves.
Yeah, and it I mean, it remains to be seen how low the price goes, and virtually impossible to forecast that. But it is an interesting dynamic when you see the price of oil come down this much, and then in the U.S., a lot of that production is at a higher cost,
Yep.
or at least the additional production. And so that also could bode well for Canada, as as the price comes down and supply is to shut off. It's probably not going to shut off as much in Canada as it does in some other parts of the world.
No, yeah, I don't. I would expect very little in Canada.
Yeah, exactly. So, Stu, interesting stuff as always. I think I think as we look at it, and I'm not going to surprise any of our regular listeners with this next comment. You already tipped it, but this is still an environment where, using the strategy that you like quite a bit, dollar cost averaging continues to be, again, if you're facing uncertainty, and there's a risk of again, some disappointments around earnings or the economy, which creates a little bit of a pocket to the downside in the markets. Dollar cost averaging continues to be kind of a fabulous way of working this market. It almost plays into again, for particularly for people who are still accumulating assets. It's just it's a fan, and still working and earning a living, getting a paycheck every couple of weeks. Just take a little bit of that money every 2 weeks, stock it into whatever investment strategy you've got in place, and this kind of a market just plays right into that, right?
Yeah, like one of the things, my mom, going through a variety of things, but one of the words, the lines that she was really grabbed onto is dress accordingly for the weather. She likes to talk about this a fair amount, and that's kind of like, it reminds me of a comment. You trade the market you have, not the market you want. And in this environment, dollar cost averaging is really, lends itself to the environment that we have in front of us.
Yeah, so like you said, cloudy for the short term. So I dollar cost average in, generally clear sailing long term as always. So by the time things clear up, you're in and away we go. And that's one of the things that dollar cost averaging does such a great job for you. And regular investing beyond that, just investing on. I mean, I think go back to our old buddy, the wealthy barber, who we did some work with years ago, and David Chilton, and so we should attribute it properly. But just the whole idea of paying yourself first, and it's I mean, it's just such a I did that from the first time I met him, which was again right at the start of my career. Done it ever since, and the wisdom in that is valid. And I just don't think it ever goes away. So my kids are doing that already, and this is something, if you're listening to the podcast, you should be doing, and your kids should be doing, and your grandchildren, and that's something, along with dollar cost averaging, as you get new lump sums that you're trying to put into place. Stu, great discussion, great to be back, and we'll see you next week.
Okay, thanks, Dave.
This recording has been provided by RBC Global Asset Management, Inc. for informational purposes only, and is not intended to be investment or financial advice. You should consult your own legal, accounting, tax, investment, or financial planning advisors before engaging in any transactions.